aspect?
Yeah, sure. So I think we have been getting a lot of queries asking from people that what is the right benchmark? Can we use Nifty 50 or can we use some other index? So we wanted to spend some more time on this because in this bubble chart, you see that most of the market indices are uh, centered or clustered in the midway of risk and reward terms. Now, if you have to zoom in only on the market indices, we wanted to just show our users like how different markets perform. So this is the uh, plot where we show 3-year rolling returns, which is on the y-axis, and on x-axis you have volatility. And similarly, we have 5-year and 7-year rolling returns. The need for showing these three plots is that we want to show not only just, let's say, the shorter term duration of 3 years. Maybe if someone is staying for a longer period of like 7 years and someone is staying for a medium period of 5 years, how would these results would pan out? So we want to show that how is that consistency being maintained if someone is holding these indices for a longer period of time. Now, this might be difficult for someone to visualize. So let me quickly pull down the picture and show the results. So let's first focus on the 3-year rolling returns. Now, in 3-year rolling returns, the one that I would want to first show is the Nifty 50. So this sets the benchmark. As you can see, Nifty 50 is around this level where you get 12.5% on an average with a 20% or 21%, 21.5% as the standard deviation. Now, if we see the indices which are towards its right are the ones which are a little bit riskier than holding a Nifty 50. As you can see, all the indices are having returns above Nifty 50 in a 3-year average 3-year rolling period. But the ones which are towards its right are a lot riskier, especially the next 50 and Nifty Microcap 250. These are the most riskiest assets. And even small cap is also quite riskier than Nifty 250, Nifty 50. Now, if you see the ones which are having similar returns as Nifty 50, but with similar volatility as Nifty 50, but with much higher returns, let's say Nifty 100 or maybe even Nifty 200. And in fact, you can also see the Nifty 50 also 500 also has a higher return with less volatility and way higher in the quadrant which just Gitya showed, where the second quadrant, which is favorable one, where we have high returns but yet with low volatility. This is the quadrant that we really like to focus on. And in this quadrant, we see 4 important indices. One is Nifty Midcap 150, Nifty Midcap 100, Nifty Mid Small 400, and Nifty Large Mid 250. So essentially, all the large and mid caps are the ones which are most favorable in terms of indexing, if one has to follow the indexing strategy. And this is not just in 3-year period. If you see the 5-year rolling return also, in this top left quadrant, you see the CM4 indices, which is Nifty Midcap 150, Nifty Mid Small 400, Nifty Midcap 100, Nifty Large Mid 250 coming up in this quadrant. And in 5 years, you see that Nifty 50 even beats Nifty 500, 200, in fact, also small cap. So small cap might be a strategy which is cyclical, and you have to have the timing right to generate returns in a longer time frame. That's the meaning of an index going down in the pecking order as time increases. Usually, we see that as you spend more time in the market, the returns should increase. But if you're seeing that the returns are decreasing as the time period increases, it means that this sector or this index is a cyclical sector. And again, you see the Nifty Microcap 250 and Next 50 being highly volatile, even though they generate higher returns. In fact, if you have to benchmark with it, then you have good alternatives with similar kind of return profile, but with much lesser volatility. Those are mid small 400 or large mid 250. And again, Nifty Midcap 150 tops here in terms of the return as well as risk. When you look at the 7-year rolling returns or the long-term side of it, you again see the Nifty Next 50 and Nifty Microcap 250 being the highly volatile ones. But Nifty Microcap 250, if you're holding for a longer period of time, then it has a very good risk reward in its favor. And the 4 important ones which are having less risk with more returns are Nifty Midcap 150 again, Nifty Mid Small 400, Nifty Midcap 100, and Nifty Large Mid 250. So the key takeaway that we can see is the top 250 stocks in terms of market cap offer a favorable risk reward as a universe in general than going down the lane of small cap or micro cap. So that's the key takeaway that I have. I think this is a myth or misconception that many people have, that only if you have to generate higher returns, you should always go down in terms of market cap to generate the excess alpha. It's not true. As you can see, these indices are favorable for investors to get better returns with similar or lower amount of risk that we take. Now, this is about the different market caps or broad market indices. Now I want to show everything together in one picture. So for that, what we'll do is, again, this code also will be shared so that you can visualize. Now this is the final insight that we want to delve deeper into. This plot, same like the earlier one, we show the 3-year rolling returns versus volatility, 5-year rolling returns, and 7-year rolling returns. But in here, we take all the indices that are listed on NSE, meaning we take the strategy or factor, we take broad market indices, we take sectoral, and we take thematic. Now, each category is represented in different color. For example, you see that strategy or a factor index is represented in blue color. So let me just show that. So the blue colored ones are factor indices in the canvas. The red colored ones are the market cap indices. The green colored one are sectoral indices, and the purple colored one are thematic indices. So this might be overwhelming when you see all the graphs together. So what I'll do is I'll show one by one, and we'll then keep adding one category of index at a time. So first, let me clean the slate completely blank and then start only with market. Now, as we have seen earlier also in the overall canvas, we have noticed that the market indices are closely clustered together. So when you see across different time frames, that is also true, and not just for 7-year time period, even for 3-year time period or a 5-year time period, all these are rolling returns. You see that the market indices are clustered closely, and they have a volatility range of 20 to 25%. So you can notice that the minimum that any equity investor needs to bear in mind whenever he is or she is entering into market, that a volatility of 20 to 25% is given. That's what is seen across the different time periods. That's one part. And the other thing that we can see is that as time increases from 3-year holding period to 5-year holding period, we see that the indices are even more closely clustered. But if you increase the time span from 5 to 7 years, then the clustering tries to expand on the upside. So some of the indices try to break away and move towards the upside, meaning if you are investing for a longer period of time in certain indices, then you might end up getting higher returns. Now let's see what are those market caps. Those are microcap 250, Nifty midcap 150, and Nifty mid small 400. So that's one insight that we can draw, that the longer you stay in the market, some of the benefits of compounding will accrue, and you will be able to reap a much higher returns. But in general, market cap indices more or less are clustered together and have a similar, if not the same, but at least in a similar band kind of a risk reward profile. So that's one that we can see in terms of market cap. So now we have seen the market indices. Now let's add strategy or factor indices and do the comparison. So you can see that the sectoral or the strategy indices are spread predominantly in these 3 quadrants. There are an exception of these 2 in the bottom quadrant. Let's again quickly recap what are the 4 different quadrants. This is the quadrant that we prefer, where we see less volatility with high returns, and hence the Sharpe ratio or the risk reward ratio will be better. This is a quadrant with an increasing risk with increasing returns. So and hence the Sharpe ratio might be normal or close to 1, but still it yields a high return. So any strategy or index which is falling in this line will have a similar Sharpe ratio of 1. If you go farther away from this point, you see that these are more riskier and hence more return rewarding, and this will be less riskier and hence less returns fetching. So you see that there are indices in each of these 3 quadrants, and there are a few indices in this quadrant as well. This quadrant has less return with high risk, and ideally we would want to avoid such. Now let's focus on each of these quadrants and see which strategy or factors are falling in these quadrants. Now this quadrant, which is low volatile as well as low returns, and you see these most of them are clustered in this zone, and no surprises here. These are mostly from low volatility and quality. Both quality as well as low volatility exhibit the characteristic of being more stable and being less volatile, and also the returns are also commensurate with the risk that is being taken here. And if you see in the top right quadrant, this is the high risk, high reward zone, and in here you find more of momentum, like momentum mid cap 150, momentum 50, Nifty small cap 250, momentum quality 100, Nifty 200 momentum 30. So these are the Nifty 500 momentum 50. This is the area of momentum and a few variations of momentum with quality. And in this bottom quadrant is what you see alpha, alpha 30, alpha 50, and value. So value and alpha are more riskier and less returns fetching as compared to other factors. Now that's the whole these three different quadrants. Let's focus on the fourth quadrant, that is this quadrant. In this, you see three important ones which are coming out. The first one is Nifty small cap 250 quality 50, Nifty mid small 400 momentum quality 100, and you also see Nifty mid cap 150 quality 50. So you see a combination of quality and momentum quality coming up on a 3-year time period horizon. Let's spend on a 5-year time period. Again, you see that this cluster is closely centered around, which is again quality and low vol. This one is quality 30, Nifty 100 quality 30. Again, the same one, Nifty 100 quality 30. Now the two values, Nifty 500 value 50 as well as Nifty 200 value 30, have now gone even further down. So if you spend more time from 3 years to 5 years, then value in fact gave lesser returns. Now this is counterintuitive. We expect that as time progresses or you spend more amount of time in the market, the higher or the better returns will be, or at least the returns will get solidified or have a similar path. But if the returns are decreasing, it means that it is a cyclical or a mean reverting kind of a sector or a strategy. So value is one such. It is deeply cyclical, and only one can time the market or has the knack to identify when is the upcycle. Then it is suitable for those kind of investors. Even though the value factors which are mentioned here are highly volatile, but volatility is not a bug; it is a feature. If someone can harness that feature, they might get great returns. But again, this is not for someone who's faint-hearted and not definitely for who's newly coming into DIY. For DIY, we would prefer somewhere in this quadrant, or maybe at least in this, or some part of this. Again, these three are three different quadrants that we've just talking about. Someone who's not willing to take more risk and is okay with lesser returns, for them the low vol and quality might be a great option. For someone who is willing to take more risk with more opportunity to get higher returns, then this quadrant might be great, where momentum does really well. And if someone is looking for a great opportunity of higher return with less risk, then there are a couple of multi-factor like mid small 400 or momentum quality 100. Then this is a great quadrant to be in. And if you look at the 7-year time frame, then there are two things that I wanted to show. That firstly, the value again is even deeper than the previously seen returns of 5-year time frame. And now the alpha has moved to a upper quadrant of high risk, high reward zone. And you see the topmost being Nifty mid 150 momentum 50. So the one inside was the value is deteriorating as you increase the time period. The second one that I wanted to show was just like what happened in the broad market indices, as you spend or wait for a longer period of time, the gap between this cluster starts to widen and the cluster moves towards the top. The same thing can be seen in the strategy or factors. As time progresses, the factors or strategies, they start to move up. So the topmost one is Nifty mid 150 momentum 50 in both 5-year and 7-year period. And on this quadrant, which we said, right, the high return and low risk, you see Nifty mid small momentum quality 100, and again in here Nifty mid small momentum quality 100 coming up in this quadrant. So that's the whole analysis on market caps and strategy. Let's add thematic and sectors together. I'm combining thematic and sectors because they more or less uh, have a similar pattern. So let's just add both the green colored and purple colored ones. Now, once you add these thematic and sectors, you see that there are quite a good sectors which are in the top quadrant of having high returns with high risk, namely consumer durable. And if you're looking at this line where equal risk reward is present, you see that there are three more, namely Nifty FMCG, health, and pharma, and also auto to some extent in this straight line. So these are the 4 or 5 sectors which offer a favorable risk reward for users who are directly trying to invest in sectors. But let's see what happens when you stay for a longer period of time of, let's say, 5 years and 7 years. Now, like what happened in markets and strategies where the clusters started to move up In sectors and themes, you see that the clusters do not go up, but they move towards the right side, meaning they do not increase the returns as you stay for a longer period of time, but they increase the volatility. So this was the cluster of all the greens. Let me just focus only on sectors for a moment so that it is easily visible. Okay. So you can see that this is the initial cluster, and as time progresses, you see that more and more of them are moving towards the right. So indicating that even sectors are not something that we can confidently go ahead and bet on. They are also having cyclicality in their as a nature. I'll just take a couple of examples from this. Let's take in this line, we have consumer durable and we have FMCG, health, pharma, and auto. So I'll just show a couple of sectors where we can see how the cyclicality happens. So what I'm going to do is, let me delete this. So this is the health sector. We have the 1, 3, 5, and 7-year rolling returns. I also captured 1, 3, 5, 7-year of Nifty 50, and then we'll subtract the rolling returns of the healthcare sector minus the Nifty 50, and we'll calculate the excess returns. So let me just plot the excess returns for a 5-year time frame and see how the excess returns shape up. So you see that there is an element of cyclicality even in the sectors which are shown to be favorable in terms of risk reward ratio. They also undergo some kind of cyclicality. And also the sectors which are in the poor quadrant or the bottom quadrant of high volatility and less risk are also not that bad either. So I'll give a couple of examples. In fact, you may not see some of the sectors in this canvas. If we zoom out a bit, you see these sectors which are not even visible when we at this level. So we have to zoom out to see the sectors which are doing really bad. Those are reality, FTPSU Bank, metal, media. Now these sectors, if you see, we'll anyhow do a deep dive later also on sectors. I'll show a couple of interesting points on reality and metal. So if you take the excess 5-year returns for metals, I'll plot it into, yeah. So this is the excess returns of realty sector with respect to Nifty 50. Since 2005 onwards, it has been underperforming, but the underperformance has slowly started to converge or started to shrink. And now you see that there is an overperformance of realty sector. So what we have seen here is a historical data from 2005 to 2024. And if you see the historical performance, you see that the sectors are not in a favorable quadrant. But that doesn't give the complete picture. You see the complete picture when you actually plot the excess returns and see that these sectors are in fact closing the gap with Nifty 50 and are in an uptrend. So this will only be known in the hindsight that metals was or reality or commodities was maybe not doing great, and that was a great time to purchase. So there's an element of cyclicality in all sectors, even in the sectors which are really good like pharma. Let's see pharma also, how the pharma's excess returns are there. You see that the same sinusoidal or cosine wave where there are ebbs and flows in the excess returns, even the so-called secular sectors like pharma or health. So sectors is not something that easy for someone to, especially if they are DIY investors. I'm not talking about pro investors, but DIY investor. Sectors or themes are not that easy to time enter into, and these are best left for the active managers or fund managers who know their game and know what they're doing. If you are a fundamental investor, maybe this can give you a starting point to see or to plot how the excess returns are shaping and what has been the historical performance. And then from there on, you can take or add more of your fundamental research and pick great stocks. But if you're a DIY investor, I think the main takeaway that we see is that the sector, the strategies or the factors, and combined with the uh, market indices. These are the great places for someone, especially for DIY investors, to start with. Indices, broad market indices, are the first preference. And second preference, if you read more about different factors and understand what are the different factors, you know which factor suits your personality, and then maybe you can gravitate towards factors. So these are the two main key takeaways. We'll again share this code with you. You can play around and maybe you can get even more insights. We're happy to listen and take more insights that you get from this graph. We have tried to show the best that we could analyze over the last couple of days and present to you. And yeah, that's it. Anything else to add, Geeta?
all the key points. So perhaps in the next coming videos, we can deep dive into each of these category and see how they're performing, and, over time, and different metrics per se.
Yeah,
So
sectors is something that definitely we can do a deep dive, and also maybe on thematic sectors.
absolutely.
Cool, great guys. I think this is a great exercise for us. It helped us also. I hope this will find enlightening and enriching for you guys as well. And we've tried to summarize all our learnings in one video and in one chart. The chart that we showed, or the graph that we showed, is massive. It has more than 400 data points. So we're thinking how best can we converge this and show it in one single shot. And this is the best that we could think of. This gives a lot of scope for improvement also. Please do suggest your improvements of how can we show this data or do it better. Thanks, guys. Have a nice day.
Thank you.